If you're taxing your financial year 25-26 income using rules you remember before 2020, especially for capital gains, mutual funds, crypto, or deductions, your return is exposed. Not because you're evading tax, but because the law has changed in very specific places and those changes are now been strictly enforced. This video is not an advice. It is a technical recap of how income earned in financial year 25-26 is taxed under the Finance Act of 2025. Save this video. This is a filing season reference material. Income earned between 1st April 2025 to 31st March 2026 is governed by the Income Tax Act of 1961 as amended by the Finance Act of 2025 and read with rules, notification and CBTT instruction. There is no new act yet, but the tax mechanics are no longer what they were a decade ago. Most filing mistakes today are not about hiding income, they are about applying outdated provisions. Charging provision, Section 15, salary taxable on due or receipt, whichever is earlier. TDS under Section 192 and reporting is done through Form 16 by the employer. Tax regime, Section 115 BAC has applicable in financial year 25-26. New tax regime is by default. Standard deduction of Rs 50,000 is available and it is allowed under new regime since Finance Act 2023. Old regime available only if opted out of new regime. Deductions and exemptions allowed but subject to certain sections. What has changed compared to earlier years? New regime is now by default. Allowance reshuffling after year end does not survive. Salary structure is digitally locked. Salary income today is final at source, not adjustable later. Salary taxation did not become heavier, it became irreversible. Charging provision, Section 22, annual value of property. Deductions, 30% standard deduction under Section 24A. Municipal taxes allowed if paid. Interest on housing loan under Section 24B, Rs 2 lakh is the limit for self-occupied property and is allowed only under old regime. Disallowed under new regime. Key enforcement change, multiple self-occupied properties flagged, lost set of tracked systemically, property data mismatch with AIS or stamp records. House property losses are no longer casually absorbed. House property income is no longer a planning tool, it is a reporting obligation. Presumptive taxation, Section 44 AD, turnover limit is Rs 2 crores, 3 crores if cash receipts are less than 5%. And presumptive income is considered 8% or 6%. Section 44 ADA, professional receipts limit Rs 50 lakhs and presumptive income is considered 50%. What has changed in practice is AIS and GST and TDS integration, year-on-year behavior tracking, sudden switching attracts scrutiny. Presumptive schemes are not abolished. Casual or opportunistic use is now risky. Today the department tests consistency and not explanation. Equity shares and equity mutual funds. Section 111A and 112A has amended by Finance Act of 2024 and applicable in financial year 25-26. Short-term capital gain tax at 20%, long-term capital gain tax at 12.5%. Long-term capital gain exemption of Rs 1,25,000. No indexation, security transaction tax is mandatory. Debt mutual funds, Finance Act of 2023 changed, fully applicable in financial year 25-26. Units acquired on or after 1st April 2023, there is no indexation, gains are taxed at slab rate and holding period irrelevant. Many taxpayers are still wrongly applying indexation. Other capital assets holding period rationalized, indexation largely withdrawn, taxation is now rate driven. Capital gains today reward clarity and not inflation math. If you are still calculating capital gains using indexation by default, you are filing under the wrong law. It includes interest, dividend, casual income. What has changed? Near total AIS capture, misclassification flagged, professional income parked here attracts notice. Other source is no longer a safe residual head. Section 115 BBH, flat 30% tax, no deduction except cost, no set off or carry forward of loss. Section 194S, 1% TDS on transfer. Threshold limits are Rs 50,000 for specified persons and Rs 10,000 for others. Crypto remains a quarantined regime. Crypto is not capital gain, it is a penalty-style tax structure. ATC Rs 1,50,000, ATD Rs 25,000 and Rs 50,000 for senior citizens. ATCCD 1B Rs 50,000, ATJ subject to certain conditions. Most deductions are not allowed under new regime. Material. Let me close this as a professional. Finance Act of 2025 did not make taxation arbitrary, it made it exact. If you use correct heads, apply correct heads, drop outdated indexation logic, respect regime boundaries, your financial year 25-26 return will usually pass quietly. If this video corrected your understanding or updated an old assumption, help you file with confidence, please save it, share it with anyone filing returns. Watch Pocket Tax Lawyer for law and not panic. In modern taxation, accuracy matters more than cleverness.